The Bank of Canada is holding its key interest rate at 5%.
Inflation has come down a lot since the summer of 2022, but as every Canadian knows, it's still too high. We held our policy rate steady today because monetary policy is working to cool the economy and relieve price pressures, and we wanted to give it time to do its job.
That announcement coming on the heels of data from Statistics Canada that was released earlier this year indicating the economy is beginning to slow down. As Canadians start to feel the impact of previous interest rate hikes, the Bank of Canada increased interest rates to 5% back in July. At that time, the bank said more hikes could be needed as inflation has been sticky above the target of 2%. The Bank of Canada expects inflation to gradually fall over the next year and return to the 2% target in 2015. A lot of people watching this announcement today to see what it could mean for their financial future. City News 680 senior business editor Mike Eppel joins us to talk about how this could impact you. So, Mike, I'm wondering what are your top takeaways today?
That interest rates aren't going anywhere, and a lot of people are breathing a sigh of relief, Melissa, simply because they've gone up so fast, and we've seen variable rate mortgages, the mortgage market, the housing market, anybody with money owed feeling the effects in very short order. Having said that, Governor Macklem was also issuing a warning in addition to the announcement for today, saying that if inflation doesn't cool off and continue to do so, they could still raise rates. That is not out of the realm of possibility. It's less likely, but, from their policy announcement this morning, they forecast that next year inflation is still going to average up around 3.5%. That's still too high. And at the same time, they're talking about, the inflation, the inflation fight slowing the economy so much so that we may or may not see a recession. So you got a lot of moving parts here where inflation has remained not entrenched yet. That's kind of what they're trying to avoid, but it's still elevated, and they might still have work to do. A lot of possibilities, a lot of variables in there.
Now, the governor of the Bank of Canada, a lot of his statement today was him looking into the crystal ball at what's to come. So it seems like the headlines aren't so much about the interest rate today, but what might be coming in the future. What kind of factors are at play there?
Well, look, that's exactly right. They're trying to guesstimate, for lack of a better term, how all of the moving parts are going to be put together. Consumer spending has slowed down. What's still elevated? The housing market and, housing prices. Those have not cooled off. Price for gas is still up, and they're talking about that going up as oil prices continue to climb. So they got a lot of things that they're pushing against with higher interest rates that may or may not actually be affected. Because when they talked about the housing market, for example, in other times you raise interest rates as much as they have in such short order, you'd see housing prices come down. Well, the deputy governor, Carolyn Rogers, said the reason home prices haven't fallen very much is because there's still a vast undersupply of houses for sale in the market. So that's something they're watching. The price for oil, again, it's north of 80. Maybe it's going to go up to 90. Well, gas prices, that's also baked into inflationary pressures. So it's going to be interesting to see exactly. There are some economists who are saying they're at the peak for interest rates. They don't have to do any more because they've already done enough to slow the economy. That's starting to be borne out. They're talking a good game to tell consumers, keep in mind that rates might have to go up. Don't overspend. Don't borrow more money if you don't have to, because they could still raise interest rates early next year.
So a sigh of relief for those variable mortgage holders, but they're still holding their breath. Something else that Tiff Macklem also mentioned, he pointed to tensions, around the world right now, that being a factor. So I'm wondering how much of this is just out of Canada's control?
A lot of it, actually. And that's been the argument against raising interest rates, because what they're doing effectively is hurting households, by, putting so much stress, financial stress on Canadian households in effect, to try to control something that they can't control. So that's the pushback against all of these interest rate hikes. At the same time, they're looking at the United States. The U.S. economy is still growing at a pretty rapid clip, and American consumers there aren't slowing down their spending. there is that disconnect between the Canadian and U.S. economies right now. And they have to watch that because that has a spillover effect on what we do here when we're talking about the valuation on the Canadian dollar and all of the trade valuations between our two countries. So yeah, there's a lot of things that they're looking at outside our borders. Some they can control, many that they cannot, but that's all also into their forecast.
Something you mentioned there too about American spending, consumer spending right now, that is so critical to these decisions that are being made. We're getting into the holiday season right now. How critical are the next few weeks?
Quite critical for the retail sector, that's for sure. And the interesting difference between American and Canadian consumers right now. What did we just hear not that long ago from Deloitte Consulting? Their holiday forecast was predicting Canadian households will slow down Christmas and holiday shopping trends. In the United States, they're raising the forecast this year because you've got a different mortgage market. And this was pointed out in the Q&A for the Bank of Canada this morning about in the States, you've got mortgages that are locked in for upwards of 30 years. They're not going to renew anytime soon. So American households aren't yet feeling the effects of all of the interest rate hikes there as quickly as we are here in Canada because our mortgages renew quite a bit sooner or faster. So we're feeling it. They're not yet, which is why you've still got this difference in the economies when we're talking about consumers and why they're a lot more confident there than they are here.
Thanks, Mike. I appreciate your insight. That's City News 680's senior business editor, Mike Eppel.
Thank you.